Investors tend to buy clean stories that are easy to understand, and they don't have to do the math and deal with selling a crappy asset. So these situations tend to persist. Over time, spinoffs have historically outperformed. They tend to continue to outperform, but every situation is different, and not every spinoff outperforms. And so,
why should you care about spinoffs? Because they outperform the market, according to both industry and academic research. And my guest today specializes in spinoffs. His name is Richard Howe, and he runs stockspinoffinvesting.com, very self-explanatory name, a website or a research service, I should say, dedicated to spinoffs. We're going to talk about what makes spinoffs so enticing today, how they work, cousins of spinoffs like split-offs and carve-outs, and perhaps most importantly, some specific spinoff investments that Richard is watching. So Richard, welcome.
thank you so much for having me on, James.
Great to have you here. Can you give people a quick autobiography of Richard Howe and how you got into spinoffs?
Yeah, definitely. So I grew up liking to invest. So my parents were both involved in equity research and bond research, and so I was able to, all my life I really loved investing. And so I started my career at Eaton Vance, which is a mutual fund shop that's since been acquired by Eaton Vance, in the equity research department. So I did the CFA program and got that, and got to work with a bunch of smart people, and got to cover a bunch of different sectors, which was really which was great, and allowed me to learn a lot about the market. In terms of when I transitioned really over to focusing on spinoffs, I read a book that some of your audience might have heard of called "You Can Be a Stock Market Genius," and it's written by a guy named Joel Greenblatt, who's a very good special situations investor. And he just talked about all special situations, but I think it was chapter 5. He spent the most amount of time talking about spinoffs and why they're interesting. Generally they outperform, and they outperform for structural reasons. And so that really got my attention. And so fast forward to 2006, I started a blog really to just focus on stock spinoffs and my interest in stock spinoffs and ideas that I thought were interested. And then a couple of years later, I turned it into a full research service, and I've been doing it really professionally for 6 years now. But it really comes down to they're great opportunities. It's what I find most interesting. And, when I was back at Eaton Vance starting my career, we were really just focused on the largest cap stocks, which it's a really competitive space to be because so many smart people are looking at those stocks. And spinoffs tend to be smaller and medium-sized companies with a lot less eyeballs on them. And so it just really resonated with me in terms of a nice, fun place to look to perhaps generate excess returns, but also have more opportunity because fewer people are looking at them.
I want to talk about outperforming in a second because that's what we're all trying to do as investors, right? Otherwise, we should just be buying an index fund. But first, if someone has Googled a little bit about spinoffs, they've probably seen spinoff, split off, and equity carve out. Can you break those apart for us and maybe mention what the tax or regulatory considerations are for each?
Yeah, so a spinoff, a lot of times a company will announce, hey, we're doing a spinoff, but it's really just an IPO of one of their divisions. So I guess, first of all, stepping back. So a spinoff is generally when a public company, spins off a portion of their business. So a lot of times a conglomerate will have, 3 different divisions, and Wall Street prefers simplicity. So Wall Street likes you to focus on, just be a pure play on one area of expertise. And so companies like GE will spin off their aerospace business or will spin off their healthcare business so that each individual business can get a pure play valuation, vis-a-vis investors in Wall Street. And so the spinoff areas of the market that I think are most interesting is when there's like 100% spinoff, because the market, when 100% spinoff happens, in other words, a company spins off 100% of their division to investors, it's very easy to value both sides of the business. It's easy to value the spinoff. It's easy to value the RemainCo. But what sometimes happens is a company will just IPO or spin off 20% of the business. And in that case, they think it's going to unlock a lot of value because they say, hey, the market will see how much our subsidiary is valued by the market. and the market will know that we own 80% of this business and our remaining businesses is being undervalued by the market. But usually the market will just assign a big conglomerate discount. So split off transactions are what I just described, where a company will generally, IPO or spin off just a portion of the business, and it's really not a full spin off. And but
In a
what
spin-off,
will
they're selling the shares. Is that, or maybe that's a carve out? Like a spin-off, you give the shares to the actual holders, right? Uh,
exactly, that's be like a 100% pure play spinoff, and then a car or a split off will generally be when you're going to IPO 20% of the business, and then you will split off the remaining 80% through a transaction. It could be another spinoff, or it could be a situation where you say, "Hey, owners of the RemainCo company, you can switch your shares of your this RemainCo for shares of the spinoff." So that's generally how it works. And then like a carve out I typically think of as like a private equity style situation where a business, maybe a company is not getting the valuation that it wants, and it's considering doing 100% spinoff, or it's considering carving out a segment and basically selling it to private equity. So that's what I really think of when I hear of carve out.
Got it. And how many of these transactions by any name happen in a given year? And how do you know a good one from a bad one?
Yeah, so generally there's about 15 to 20 in any given year. If there's a big market dislocation, maybe the spinoffs that have been announced last year happen. So maybe it's closer to like top 10 transactions that'll happen. But if it's a decent year, you'll get 15 to 20 decently large spinoffs that take place. In terms of knowing whether it's going to be a good transaction or a bad transaction, I feel like every situation is a little bit unique. Um, and there's also a lot of different ways to play it. For instance, you could play the situation where a company, the parent company is spinning off a dead weight division that's burned a lot of cash, and so the play really there is to buy the company before the spinoff, and then the remaining company will re-rate over time. Other situations are where a big division is spinning off a smaller subsidiary, but you think the smaller subsidiary looks really, really interesting. And oftentimes, when a large company is spinning off a smaller subsidiary, there's indiscriminate selling, and we can get into exactly why indiscriminate selling pressure happens. But oftentimes, if you've done work on a small spinoff that's going to take place, and you think you would buy it at a certain valuation based on the financials that have been published ahead of the transaction, and then the spinoff happens, and because large cap shareholders don't want to own shares of a large cap, and you see these waves of forced selling pressure, that oftentimes those are my favorite situations when you see basically a small cap that's being sold for no reason other than large cap managers don't want to own it and index funds can't own it. But you can buy really high quality companies that are sometimes growing, sometimes not, but very cheap at a really attractive valuation. So those I would say are my favorite transactions, but it really varies depending on the situation.
So broadly speaking, in terms of spin-off investing writ large, you could have a situation for the big company spins off some garbage, or it spins off a crown jewel. And you want to be open-minded. Sometimes it's better to buy the holdco or the RemainCo after the garbage is gone, or you want to buy the crown jewel. It could go either way, right?
Exactly. And then this book that I referenced earlier, You Can Be a Stock Market Genius by Joel Greenblatt, he says one of his rules for spinoff investing is buy the garbage, buy the toxic waste. And the reason why he says that is because nobody's going to want to own it. Nobody's going to want to touch it. Everybody's just going to hit sell when they receive this toxic waste. And it can create a really interesting opportunity. I will say I've learned the hard way that like some toxic waste actually is toxic waste. So, but there are situations where you can buy something that's perceived as toxic waste that is actually a really interesting opportunity. I'll give you an example. So, Anglo American, a big mining company, global company, spun off a company called Thungela Resources in South Africa. And it's a small cap coal company. Nobody wants to own a coal company. It is the dirtiest of the carbon, of the fossil fuels. There was also a report that came out that suggested that this company Thungela had basically uncapped liabilities, for shutting down and remediating some of its coal mines. And so it looked like an absolute disaster. But if you looked at the fundamentals, this company had no debt. It had basically half its market cap in cash. And then at the time of the spinoff, coal prices, this was like shortly after COVID, I think 2021, were inflecting higher. And so you didn't really have to do any advanced modeling or anything like that to understand that this company was going to be earning a ton of cash. It had no debt. And then it had already announced that it's going to pay out 50% of the free cash flow that it generated to shareholders. And if you just ran the math, it looked like it was going to be like a 30% dividend yield that they were going to declare. And so that was a situation where something that looked like toxic waste actually was really quite compelling. Another example where there was toxic waste that actually was toxic waste was Honeywell spun out a turbocharger business called Garrett Motion. And Honeywell just basically wanted to get rid of this asset. There are appealing things of Garrett Motion. I actually own it now for separate reasons. But what they did was they spun off Garrett Motion at the peak of the automotive cycle. So you're owning a highly levered auto supply parts company after 10 years after there's been a recession. And then they stuck Garrett Motion with billions of dollars of asbestos liabilities, just to get rid of it. The asbestos liabilities were not generated by Garrett Motion. They were generated by the rest of the Honeywell Corporation, but Honeywell just wanted to send that toxic waste off with the spinoff. And it ended up being toxic waste. Garrett Motion ended up declaring bankruptcy to basically deal with those asbestos liabilities. But in that situation, the toxic waste actually ended up being toxic waste. So as you said, every situation is unique. Sometimes something will look horrible and be a little bit better than it looks. And sometimes the situation will look horrible and it'll actually be pretty bad.
And I guess then the holding period of the spinoff varies totally based on why you're holding it. It could just be a really great long-term hold, or maybe it's more of like a arbitrage play. And let me ask about that, actually. Investing is a subset of economics, and economics is a social science. Investing is a very reflexive social science, meaning kind of like lines at Costco. If a new line opens up, people quickly go over there, and eventually all the lines kind of equal out. And usually when some market-beating opportunity has been unearthed in investing, people pile in until it's traded away. On your website, though, you cite, 5 or 6 different studies showing how great spinoffs are. Statistically, they beat the market by 11%, 13%, whatever. I'm forgetting the exact numbers, but something like this. My question is, why does that persist?
Yeah, it's a great question. And in all fairness, I think like more people than me have read Greenblatt's book, You Can Be a Stock Market Genius. So I think the market has gotten more competitive. And I don't think every opportunity, I don't think it's as much of a home run maybe as it was in the 80s when Greenblatt was doing it. But I don't know exactly why the situation still exists. But I think it's human nature. It's structural. It's a little bit structural in that,
like with indexes or ETFs, you mean?
Yeah, exactly. So ETFs and indexes and large cap managers have to sell these small cap holdings that they receive. And so you're going to have a situation when the valuation of a spinoff at the initial trading date is going to be low by definition because there's a lot more sellers than buyers. And there's nobody that really wants to buy these things unless there's somebody who's actually rolled up their sleeves and done their work. And then the other situation is like sometimes, for instance, Howard Hughes, and this is a name that maybe we'll talk about a little bit later, but Howard Hughes is a company right now that recently spun off a segment called Seaport Entertainment. Mm-hmm. And Seaport Entertainment has been just an albatross for the past 10 years for Howard Hughes. Investors are sick of hearing about Seaport Entertainment. It is a big development in New York City that Howard Hughes has been trying to develop for years and has just been continually burning cash. And investors are just sick of this. They want nothing to do with it. And, my thesis going into Howard Hughes and buying Howard Hughes was that investors were waiting to buy into Howard Hughes until after the spinoff took place because this was just such a crappy asset that they didn't want to own. And theoretically, from like a rational economic perspective, That's fine. You could buy the spinoff, buy the stock pre-spinoff, and then just sell the spinoff when you receive it. But for some reason, investors tend to like to buy clean stories that are easy to understand, and they don't have to, um, don't have to do the math and deal with selling, a kind of a crappy asset. So these situations like tend to persist, and I can't explain exactly why they do. I can just say that that my experience has been that they do persist. And I will say, over time, spinoffs have historically outperformed. They tend to continue to outperform, but every situation is different, and not every spinoff outperforms. And so, you can have wildly big winners and wildly big losers. And there are definitely spinoffs that go bankrupt. It's not like a situation where 90% of the spinoffs outperform. It's probably close to like 50, 55, or 60%, but the winners tend to do incredibly well. So that kind of skews the average a little bit higher. And then, like Greenblatt, he's also written about value investing. And he says the reason why value investing works is because it doesn't work all the time, right? Somebody will try it, and there'll be a period of 2 years, 3 years, or 10 years, like we're in currently right now, where value investing doesn't work. And I think that's also the case with spinoffs. You read the book, you can be a stock market genius, just say, oh, this is easy. I just buy every spinoff and they outperform. And then you learn that some of them don't. Some of them are toxic waste and go bankrupt. And that creates more opportunity for other people coming in.
One of my investing rules of thumb is that there's profit in ambiguity, profit in complexity. It sounds like there's plenty of that in spinoffs. So maybe that's why there's some profit, in addition to those structural things too. In a note, Rich, you sent me one other name, Liberty Global. Maybe as we start to wrap up, can you, everyone loves specific ideas. Can you tell people why that's on your radar?
Yeah, of course. Yeah, so Liberty Global is a name that I actually like a lot. So it is basically controlled by a guy by the name of John Malone, who is a pretty big. He's created a ton of value over time, but recently his stocks that he control, he's involved with Warner Brothers. He's involved with Sirius XM satellite radio, and some other Liberty companies have not done quite as well. And so there's a little bit of investor fatigue with John Malone names. Why I think, or just to give you a little bit of a step back and give you a little bit of a background about Liberty Global. So Liberty Global is a big conglomerate. It owns a bunch of telecom assets in all around the world, mainly in Europe, and it's trading at a big discount. So if you just add up like the cash on its balance sheet and then value the individual companies that it owns worldwide, it's trading at a big discount to its sum of the parts valuation. And Liberty Global even provides its own NAV estimate, and I think they estimate NAV at about $45 per share. The stock trades at about $18, so clearly a big discount to where management thinks it's fairly valued. But some of the part discounts aren't that interesting unless there's a catalyst to unlock value. And the key catalyst here is that Liberty is going to be spinning off their Swiss telecom asset, which is called Sunrise. And the key thing to understand here is that Sunrise has already disclosed that they're going to pay a dividend. And if you do the math on the dividend and assume that it trades at about a 6% yield, which I think is pretty conservative given that its closest peer in Switzerland trades at a 4% yield, that spinoff is going to be worth about $12 per Liberty share. Right now, the stock trades at $19, so you're getting almost 2/3 of the stock price back vis-a-vis this Sunrise spinoff. And then Liberty also they have no debt on their books. Their underlying subsidiaries do have debt, but they have no debt. But they have $1.5 billion of cash, $1 billion of listed investments, and then about $2.4 billion of other unlisted investments. If you even discount the listed investments and the other ventures by 75% or 50%, you get about $9 of value just for that cash in those investments. And so you basically cover the entire stock price of Liberty Global right now with those just talking about that cash and those investments, and then the Sunrise spinoff. And then they also own a bunch of other telecom assets that are generating hundreds of $1 million of free cash flow that they're going to continue to own. So it's basically a sum of the parts story with a hard catalyst that's going to be unlocked by the end of the year. The spinoff's going to be happening by the end of the year. And then the nice thing too is that Liberty Global is very aggressive in terms of buying back its stock. They're going to have about $1.5 billion of cash to buy back their stock. Hopefully on the cheap. So that is, that's basically the pitch in a nutshell and why I like Liberty. I own it. It's one of the names that I'm recommending to my subscribers.
Yeah, sounds interesting. And let me ask you on the downside of the risk, and this is something that applies to any spin-off, I think. It's easy to say, okay, this piece is worth this much, this much, this much, so it should be worth more than the current stock price of the kind of the combined company right now. And if the market keeps the multiple the same for each of those pieces, it would indeed work out like that. The risk would be that if for some reason either the RemainCo or the spin gets assigned a lower multiple, meaningfully lower multiple, then the spinoff wouldn't go as well. Is that roughly right?
Yeah, that's exactly right. And I would say the spinoff is going to be a highly levered company. And I think the key assumption that I'm making is the dividend yield that it's going to trade at. So I'm saying it's going to trade at a 6% dividend yield. Its peer, which is lower levered, is going to trade at a 4% dividend yield. So you could make the case that it's going to trade at like an 8%, 7%, 8%, 10% dividend yield. And in that case, not as much equity value would be unlocked, but still a good amount of equity value would be unlocked. So instead of maybe getting $12 per share value, you're still getting $6. And then just my experience, it is incredibly simplistic, but my experience has been that investors really like dividends. And once that dividend is declared, usually the stock will re-rate and normalize that dividend. I saw it, Contour Brands came out and sold off sharply, but then declared its dividend and re-rated. Jackson Financial was another name that telegraphed what dividend it was going to pay. The stock initially was spun out and sold off, but then it re-rated sharply and has done incredibly well since the spinoff. But yeah, that is definitely a fair point. That if my valuation is wrong on Sunrise, then not as much value will be unlocked. I still think, even in a more conservative situation, I still think that it will unlock value. And again, the analysis that I did got you over $19 per share, and you're not giving any credit to Liberty Global's remaining telecom assets, which are generating substantial free cash flow. And then the other risk that I would highlight is just that the transaction doesn't happen. So like I wouldn't own this name if this spinoff wasn't happened. So if for some reason this spinoff gets canceled, even if the stock traded down a bunch, I would probably sell out because it just I think that's the catalyst that you need for these sum of the parts stories to truly unlock value and make money.
So if someone is watching this and says, "Hey, this sounds good. I want to pursue these spinoffs and learn more," and they want to pursue some of your research in particular, Rich, where would you send them? Stockspinoffinvesting.com?
Yeah, go to stockspinoffinvesting.com or just Google stock spinoffs, and I should pop up stock spinoffs Rich Howe. And check out my site. I have a bunch of free stuff. I send out free emails. I have a free spinoff calendar, so check that out. And then if you have any questions, feel free to shoot me an email. I'm at rich@stockspinoffinvesting.com. I love sharing ideas, talking ideas. If you have any ideas, spinoff or other special situation, let me know. I've gotten a lot of great ideas from subscribers and other investors. And then I'm also pretty active on Twitter. I get a lot of value on Twitter, or X as it's now called. My handle there is @stockspinoffs with 2 S's, or you could just search for Rich Howe on Twitter, and I should pop up as well.
We'll put some of those links on the screen. Rich, you've been very informative. I'm going to go take a deeper look at spinoffs myself now because, hey, I like to beat the market just like anyone else. So I think a lot of the audience will as well. So thank you very much for sharing your time and your insights with us. And thanks to you guys, as always, for watching us at home.